on today's webinar on pensions. So we've invited John Forsythe to join us. Hi, John. So just to give you a bit of background on John is a financial broker based in Carrigaline here in Cork. He's a qualified financial advisor and retirement planning advisor. John worked as a financial advisor since 1991. And in 2009, John established his own firm, Forsythe Financial Planning. John advises on a wide range of financial services, including investments, income protection, and financial protection for businesses and individuals. John has specialised in both pension and retirement planning and works primarily in these areas with professionals and business owners. So, John, we have a lot of people joining us today, I guess, from, varying demographics. We've had, a huge interest on, the subject of pensions. Most people are probably a bit like myself. They know absolutely nothing about pensions. So if I could just start really by asking you simply, what is a pension?
A pension, it's a fair question, Cliona. Listen, and thank you for having me along today. So hopefully get a bit of light on the whole area and help some people out. A pension, just the simplest way of describing a pension is that it's a flexible, medium to long-term savings plan, which is set up in a very tax-efficient manner to help people provide funds to replace their earned income when they decide to step back and retire. Now, there are other ways of doing it. But pension plans in particular are very attractive because they're very flexible, they're very portable, and they're extremely tax efficient. So for somebody who's, let's say, looking at starting a pension or maybe taking control of their own pension at the moment, it should form the keystone of their financial planning. I suppose from my own background, I've been involved, as you say, in the financial industry since 1981. And I've dealt with all forms of people, from self-employed, they can be sole traders, partners, company directors, employees who don't have pension plans in place, or people who may have worked overseas and have come back and they find out that there's a gap in their pension planning and they would need to do it. So I suppose since 1991, the pension landscape in Ireland has changed remarkably over the last number of years. Especially, we've seen various government departments have highlighted that there's actually a bit of a pensions time bomb coming down the tracks, because we have a rapidly aging population in Ireland at the moment, and currently I think it's 23% of the population are over 65 and receive some form of pension. That's due to increase by 2050 to 47%. So what it means is that if things don't change, and if government don't introduce some legislation to address that, we'll simply run out of money. As a country, we won't be able to provide a state pension, and there'll be some unpalatable decisions that have to be made. Now, from a contractor's point of view, I believe that actually raises some opportunities, because one of the ways that the government are going to address that situation is to encourage more and more people to fund for their own retirement plans. And in doing so, they'll be introducing incentives to bump up the incentives that are already quite generous. There are quite generous incentives there at the moment. But for contractors and self-employed people in particular, they should keep a very close eye on this space, because going forward, you're going to hear an awful lot about pensions and various incentives that are coming down the tracks to make it even more attractive to look after your own retirement. Because when you're self-employed, whether you're a sole trader or you're a company director or whatever, nobody else is going to take care of your pension plan. It's down to you solely, unless you're content to maybe rely on the state pension. But I don't think a lot of people are in that space. So again, there is a problem facing the government over the next number of years. It is something that will have to be dealt with, and one of the ways they're going to deal with is to incentivize it, to make it more attractive for people to take care of their own pension funds and to take more control of it.
Good. Okay. And John, I just might mention at this stage that, people obviously have all kind of different situations. So if anybody has a question, you might ask it there in the Q&A, and we'll try and get to specific, answers from John at the very end, time permitting. John, you mentioned tax there as a benefit. In general, what are the benefits for anybody starting a pension?
Well, yeah, if you're starting a pension, or even if you haven't taken a look at your pension in quite some time, the taxes is the big imperative to do it. Tax certainly. For contractors, will know that if you're earning money, part of that is that you have to set aside some money to pay your tax. So you're going that's a fact of life. And a pension plan is one of the very few areas now available to reduce the amount of tax that you pay.
Okay.
Like there are other ways of accruing funds to replace your income when you retire, but they all come with a certain level of health warnings. I often hear from people, for example, that their business will be their pension, but if somebody had been relying on that over the last 12 months and had been relying on selling their business, good luck with that. Since with the pandemic,
Yeah.
it's legitimate to say that your business may be your pension, but that does come with a lot of health warnings. Other people I hear would say, look, I'm happy to invest outside of the pension structure. I look after my own investments. I'll put together a portfolio of investments. That's fine. But any money that you make on that will be taxed at 41% because there's an exit tax applied to investment growth, and that's currently 41%. So you're taking income that you've already paid tax on, you're investing it, and then you're paying tax on the investment growth.
Okay.
If you leave money on deposit, I come across people as well who say, look, we've money on deposit, I'm happy to let that build up over time. We'll dip into it if we can, but we try and leave as much of there as we can. Again, interest rates at the moment, you're getting practically zero. If you do get some bit of interest, you're going to be hit with 33% dirt tax. Other people would say, from time to time, yeah, I'll buy property and I'll rent it out and then I'll sell it. Fine, you'll pay tax on your rental income. You'll also pay capital gains tax when you decide to dispose of the property.
Okay.
By putting money into a pension plan, your growth within the pension plan is completely tax-free. So there's no dirt tax, there's no income tax, there's no capital gains tax, and there's no exit tax. In addition to that, any money that you put into the pension is allowable as it's tax deductible at your marginal rate, which is your highest rate of tax. So for a contractor who decides they're paying 40% tax, every €100 that they put into a pension plan, they will receive 40%. They'll receive €40 tax relief if it's a personal pension. If it's a company pension, they'll get 52% tax relief. Now, there's no other structure out there that will give you that level of return. In addition to that, then, as I say, the funds will grow completely tax-free. You've no dirt tax, no exit tax, no capital gains, like I mentioned a minute ago. So you've more of your money working for you for more of the time. So that's a great investment as well, in the sense that it rolls up on a tax-free basis, unlike the other alternatives. When you come out the other side of it, then you decide, I'm going to draw my pension, you will qualify for a tax-free lump sum. If it's a personal pension, you will be entitled to take up to 25% of the fund as a tax-free lump sum. And the balance of it, then you can withdraw it in a very tax-efficient manner, utilising various credits. If it's a company pension, you have an option. You can either take 25% of it as a tax-free lump sum, or you can take 1.5 times of whatever your final salary is as a lump sum. And a lot of people use that to fund for a tax-free lump sum when they retire. Other than the tax-free lump sum, then you have a residual income, and because your tax situation will change post-retirement to what it is pre-retirement, you will be able to take an awful lot more money if you're out tax-free. So, for example, a married couple can actually take $36,000 a year completely tax-free. Now that's on top of the state pensions. I mean, that's a great incentive. So I mean, I suppose the imperative is there, like looking first that people have to do something. If you don't do a pension, that you're basically relying on the state. So that's the first reason to do a pension. But the tax benefits that are there are very, very generous at the moment. And as I pointed out earlier, because there'll be a need for the government to encourage people to do their own pensions and to look after their own pensions, it's likely that those incentives are going to be, it'll become even more attractive over the next number of years to invest in a pension plan. So it's definitely one to pencil in.
And I suppose something that a lot of people weren't aware of, really, John, you mentioned married couples there, maybe people didn't know that and need to investigate. And likewise, that obviously the tax benefits there are something that really, it would be a good idea to talk to a financial advisor and kind of really get a good breakdown. So what I thought I would do today, John, is like I mentioned earlier, everybody has their own kind of personal scenario. I thought I'd come up with maybe 2 or 3 generic ones, right? So I want to talk to you about Gabriel, right, who's a 28-year-old web application tester working on a year-long contract with a multinational tech company, okay? Working, I suppose, kind of in the contracting land, this would be typical, okay, of somebody that I would work with. So Gabriel intends to keep contracting long-term as the pay is better and he enjoys the variety. He has never had a pension and wants to start one as soon as possible, but he's concerned about balancing contributions, high rent, etc. So I suppose you're talking about a 28-year-old working, contracting, and considering their finances and what have I got to pay, really rent-wise, food, all those, what have I left over? Yeah. A lot of people, young people, really think, do I really need a pension 100 years away? And I remember thinking like that as well. Back in the day, rent, food, etc. are your priority. So what would you recommend for Gabriel?
Well, first off, I totally understand, because I was 28 months as well. Yeah. A pension is something that pension to a lot of people conjures up an image of somebody going on to the post office.
Yeah.
Collect their pension, and it's down the road, and I'll worry about it. But if Gabriel is, he's contracting now and he's making decent money, so that means he's going to be paying tax.
Yes.
If he's paying tax, not having a pension he should have a pension, because it's one of the few ways he can reduce the tax bill. He's going to be writing a check to the revenue commissioners. Why not write a smaller check and send it off to the revenue commissioners and pay something back to himself? Mm-hmm. In somebody like Gabriel's situation, where he's a 28-year-old guy starting out, something like a PRSA, which is a personal retirement savings account, will give him a great deal of flexibility. He can stop, he can start, and he can vary the contributions to suit himself. He can use a single premium. He can take a lump sum every November. His accountant will advise him what level of tax he is due to pay, and he can use a lump sum to reduce his tax bill. Now, especially in the first couple of years that he's doing that, it's very, very beneficial, because let's say in November he's given a certain amount of tax that he needs to pay. He can put a pension in place and he can backdate the tax relief on that to reduce last year's tax bill, the one that he's settling this year. But that has a knock-on effect then as well, that his preliminary tax for the year after is based on his previous year's tax bill. So by reducing last year's tax bill, he's also reducing next year's preliminary tax bill, or the bill he has for preliminary tax. So you're getting a double whammy when you're starting out. And then it rolls along, you get your 40% tax relief every year. So for that. And again, with a young guy, you factor in like that he's worried possibly about rent and other business, maybe saving to build, get a deposit for a home, run a car, just have a lifestyle. Socialising outside of COVID. Socialising, exactly.
Honest, and that's you're 28, in the normal world, but
that's what life's about. You know what I mean?
Yeah.
But the pension plan is flexible. Nobody's going to be handcuffed to a premium even if he starts it off small now.
What's small?
Small. I would suggest maybe even €200 a month. That €200 a month, if he's paying 40% tax, he's going to get €80 a month tax relief on that. So the actual cost to him is only €120 a month. And as I say, he's not handcuffed to it. If his circumstances change, if he's out of employment or whatever, for a while, you can suspend the premium and come back into it later on without any penalties. It's portable if he decides to go working for a company again that perhaps contracting isn't for him and he takes up paid employment. He can transfer the PRSA into a new scheme that his employers may have, whether it's a PRSA or a company pension plan. He may decide to take off and head off around us to Australia or Canada or something for a couple of years. He can make the pension paid up, leave it there to continue to grow. So there's great flexibility around it.
Okay.
And it's a very tax efficient means as well. So it's a double-edged sword, I suppose.
Yeah. That's good to know. So he could have a pension, John. He's working away. His contract is coming to an end, and he's thinking again. Let's pretend we're in the real world now, and COVID isn't there. And he decides to go travel. You're saying he can put his pension on pause. Off he goes, comes back to Ireland, and he can pick it up again.
Yeah, or he could continue to contribute to it, depending. Like if he takes up employment overseas with an Irish company, for example, and they're paying him, it can all be done electronically, so he can continue to fund it. But if he decides, no, look, I'll just leave the pension there for a couple of years and I'll pick it up again when I come back, that's fine. The modern pension plans are entirely flexible and very, very portable. And as I said, they're extremely tax efficient as well.
Okay.
So that would be something for someone like Gabriel who's looking at maybe starting a pension. The one thing I would say is don't kick it down the road, even if he starts it small. It's better than putting it back for 4 or 5 years when he's maybe bought his house or he's settled his car, he's back from Australia. The best thing to do is to start it now, because you often see media stories there about the costs of pensions and it's all about fees and commissions, and that the biggest cost involved in a pension, the most expensive part, is delay. The longer you delay, the more expensive it will be to get anything worthwhile out of it in the end. So bite the bullet, even start it small and keep it going for as long as you can. And bear in mind that, again, as I say, you're not handcuffed to it. If you need to change it, you can change it later on.
Yeah, I'm just wondering how many people have we listening to us now today who are kind of out of college in their first job and who are thinking, yeah, okay, probably not a bad idea. I remember when I was at that stage, I used to think, oh, pensions it's just not something I'm going to think about today or for another long time yet.
Yeah, there's actually a very good, I saw an ad. No, I tuned into these because with the pensions and stuff. But there's a good ad running at the moment from one of the insurance companies. It's a guy looking into a mirror. It's an old guy looking into a mirror, and his younger self is looking back at him. And it's your older self will thank your younger self for what you do, and it's true. Like it's 1991 I started out this business, and I can't believe I'm nearly 30 years at it. Time actually flies.
Yeah.
So and if you're lucky, time is going to pass anyway. So you might as well try and do the right thing. And even if it's only small, start it now, because you'll thank yourself later on. Your older self will thank your younger self.
Yeah.
You know.
Absolutely. So, John, let me talk to you now about Anna. Okay. So, Anna is a highly experienced QA manager working for a biopharma company on an 18-month contract.
Mm-hmm.
She has worked in the UK for 8 years, and for 3 of those years, she contributed to a company pension plan with an employer. So that essentially would have been a British pension, okay? At 37, she's put off starting a pension long enough and has decided now is the time to get it going again. So she's returned to Ireland, she wants to get it going again. How should she kick off the process, and how much should she put in?
Okay. Yeah, Anna actually reminds me very much of the case I dealt with last year for a guy.
Okay.
So I might just I leave the name alone, but it's very simple actually. In that he was a dentist and he did his dentistry training over in the UK. He finished off his qualifications in the UK, and his first work was in the UK, and he was contributing to a company pension as part of a dental practice over there. And he, a number of years later, came back, and he also had 2 personal pension plans over there as well. So as part of his pension review or whatever last year, we were looking at what to do, and we decided to bring over his UK pension over here, because he reckoned at the age of the guys who were running the practice that they were going to be retiring shortly, and that the practice was going to, I suppose he just didn't want to take chances. He still has 20 odd years to go before he's looking at retirement, and he felt it might be better to take control of the pension and bring it back over here. Now, in Anna's situation, if she has a UK pension, she can do the exact same. There's a bilateral agreement between the UK and Ireland, and it's relatively straightforward for people to bring back a pension from the UK and to transfer it to an Irish company over here. In Anna's situation, if she is continuing to work as a contractor, she would have 2 choices. She can either set up a personal pension if she's going to stay working, let's say, on an umbrella company or as a sole trader. If she goes down the route of setting up her own limited company, she can set up a company paid pension and she can transfer her UK pension into that. So she can take control of that. The other thing then, of course, is just to start again. She could start with a PRSA and start putting money aside now, so there's no break in her contribution level. If, for example, she's intent on setting up a company, but it might be 2 or 3 years down the road, she should just, again, bite the bullet and start the PRSA and throw some money into that to get it going again. Transfer the pension from the UK over, and that'll give her a good bump start. Another issue for Anna would be to take a look at her PRSI contributions to see what level of state pension she would be entitled to. And I would encourage anyone who's listening in today who is unsure of where they stand with PRSA contributions to go to mywelfare.ie.
Right.
And you can download your PRSI contributions from day one, from day dot. It's all written out there. You will be able to work out how many credited PRSA contributions you have and how many you're likely to have going forward, and that'll determine the level of income that you'll have from the state pension. In Anna's situation, because she may have been paying the equivalent of PRSI national insurance in the UK, again, there are credits allowed for that when you transfer back over here. So the two systems actually interact very well together. So I suppose anyone who's in that situation who may have worked overseas, it is possible to bring back your pensions. It's just there are bilateral agreements with a number of different countries all over the world, and it's not straightforward, but it's not overly complicated either, because the systems do seem to work well together.
Okay, so that's any country overseas, and just with the UK in particular, there's no impact.
No, what they're saying though is obviously has to be put to it'll be tested because we've only just had Brexit.
Yeah.
But one of the first areas that they did iron out was the whole area of pensions, because a lot of people live in Ireland who are drawing UK pensions and vice versa. So like there is a kind of a special relationship between the two.
Okay.
So what we have been hearing from the Revenue Commission and from interested parties is that it is working quite well.
Oh, good.
That Brexit hasn't really affected to that extent, to a large extent. Other countries around the world, you get the obvious ones like North America, USA, Canada, New Zealand, Australia. Like there are bilateral agreements in place with all of those. So once the boxes are ticked, the I's are dotted and the T's are crossed, it is possible, if you're interested, to bring back any overseas pensions that you have and take control of them over here as well.
And would that be your recommendation, Jan?
Well, it depends. It's horses for courses, Cliona. Like everybody's situation is different.
Okay.
I've come across an awful lot more of it over the last couple of years, because people, I suppose, if they have children especially, they decide whether they bring them up overseas or bring them back to Ireland, or bring them up in Ireland, sorry. But it is pretty much horses for courses. But where people do decide to bring back a pension, it is a relatively straightforward process, you know.
Now, Jan, thanks for that. And I'm going to present another scenario now. So this time it's Mick. Mick is a 42-year-old PMO manager in a permanent job, we say with a financial tech company. Okay. Mm-hmm. Up until now, he's worked in permanent roles. This is somebody who's been perm throughout their career. However, he's thinking about making the switch to contracting for greater flexibility and more career opportunities. Okay. Now he's worried that what will happen, about what will happen to his pension that he's, built up in, permanent employment capacity. And what will happen to that if he makes a move? He has a young family. He needs to factor in this with his decision. So somebody who's, 42, kind of, we'll say, after their career kind of under their belt in a permanent role, built up a pension, now moving to contracts.
Yeah, but obviously that's a huge decision to make, and there's other factors to consider as well. But from a pension point of view, the first thing that Mick should do is contact his employers and establish who the trustees of his existing plan are, and from the trustees request information about his current plan. First thing he needs to do is find out what type of plan is it. It could be, if it's a company pension plan, it could be a defined benefit plan, which is unlikely but possible. It could be a defined contribution plan, or it could be a mixture. It could be a hybrid of the two. A lot of the larger multinational companies have gone down the hybrid route over the last number of years, because defined benefit plans have become very, very expensive. and they're trying to shift more and more people. They're trying to reduce costs of their pension plan and move people to the defined contribution one. Defined contribution one is very like a personal pension, in that the benefits aren't guaranteed and will be dependent upon how well the fund performs and how much of the fund is there. So that would be the first thing I would encourage someone like Mick to do, would be to contact the trustees and to find out what are his options then. If he decides to leave the company, he will be given a number of different options. First one is he'll be offered a transfer value. So he'll have to make up his mind, do I take the transfer value and reinvest the money myself? Other than that, he may be, if it's a defined benefit, he may be offered what's known as a preserved benefit, which means it's a pension that will be set aside for him to draw off at when he would have reached the normal retirement age of the current scheme. Normally that's 65. Mm-hmm. Now that guaranteed level, that income is increased every year. Different companies have different ways of doing it, but it's normally increased in line with inflation. So he'll get the kind of pro rata benefit of it at age 65. Okay. But what Mick, was it Mick? Is it?
Yes, yeah.
Mick would do is Mick, like if the circumstances suited him, Mick can actually transfer his value into what's known as a personal retirement bond and take control of the pension himself. Now he's 42 years of age now. At age 50, one of the big advantages of a personal retirement bond is that at age 50, Mick will have access to that money. So if he wanted it, he could use it to clear off some loans, he could pay off his mortgage, he could use it to fund his children's education, he could use it to leverage to up his business, but he'll have control of that money. And what he should also look at then is obviously starting another pension for his income as a contractor, as a sole trader, either as a sole trader, partner, or if he goes on the limited company route to start a pension. And he'll have two horses running in the race. He'll have control over both of them at that stage. Another important factor I would suggest for Mick would be, as he has a young family, he should take a look at what sort of ancillary benefits are included in his current pension plan. It's highly likely, if it's a decent pension plan, that it'll include death and service benefits, which normally death and service benefits would be, you can be paid up to 4 times your gross annual income as a once-off payment on debt, plus whatever the value of your pension fund is. So that's fairly substantial. And to walk away from that without investigating alternatives would be very, I believe, a bit reckless. Yeah. He may also have income protection plan or sick pay in place, and that would be another consideration. So now the good news is, for anybody who's looking to move away from that, you can transfer your pension fund, as I say, or you can leave it there and have it managed for you. But if you want to, you can transfer it as well. And you can also put in place life insurance and the income protection and claim tax relief on it. Both of those, when they're done under a pension, are tax deductible, and they're tax deductible at your marginal rate. So you're getting 40% tax relief on your life insurance and on your income protection.
Only when it's under the pension?
But the income protection can be done on a standalone basis, and you can still claim tax relief. You can do what's known as a pension term assurance policy for the life insurance, and that qualifies for tax relief then as well. Now, the great thing with the income protection as well is that in addition to ensuring your income, if you're unable to work due to illness, accident, or disability for a prolonged period of time, you can insure your income, but you can also insure your pension contributions. So while you're recuperating, you have an income coming in, and your pension is funded. It's continuing to fund, so there's no break in the contribution level. Okay. So, and again, it's all tax deductible, and it would make sense, I think, for somebody in that situation to look at everything, look at the whole picture.
Okay.
You know,
John, I have a question that's come in here from one of our contractors. Actually, he's just asking, can you be specific, or can you say what is the difference between a company pension and not a company pension?
Okay, yeah, it's a good question. Yeah, pensions, they break it like you've got a personal pension for somebody who is trading as a sole trader, or they may be in partnership with somebody else, but effectively they're self-employed. And a personal pension, you put in your contributions into it and you get your tax relief. Okay. A company pension, let's say if a contractor decides to set up a company as a limited company, and they establish a company pension, that means that the company is paying the premiums on their behalf. In a personal pension, you pay the premiums yourself. But because the company are paying the premiums on their behalf, there's a lot more scope for larger contributions and for more tax relief as well. They're a lot more tax efficient if you can set up that structure. But I suppose to answer the question, like a company pension is basically where the premium is paid by the company. Now, the individual can also contribute to it and claim personal tax relief as well. So, like for example, somebody who's 40 years of age can claim 20% tax relief on their own personal contributions, and the company can put money in on their behalf, and they'll immediately benefit from 52% tax relief, because the money that's put into the company pension plan avoids income tax, USC, and PRSI. So it's taken off the top before any of those are levied against it. So I hope that answers that question. Like, the company pension plan basically is where the premium is paid by the company as opposed to an individual.
Okay. Another question for you, John. If you have a private pension set up, okay, when it's time to, when it's time to retire and you're done from that, are you also entitled to the state pension?
Oh, absolutely. Yeah, absolutely. You are. There's no, in fact, like as I was saying earlier, the state are going to encourage more and more people to do that.
Okay.
Because the more private funds that people have, whether it's a company pension or whether it's a personal pension, it's basically to do the same job as provide you with a level of income to supplement the old age pension. The old age pension in Ireland is currently €12,956 a year for a single person.
Right.
It's slightly less than 20,000 for a couple. It was never designed to provide people with the level of the type of lifestyle that they might have been used to. It was to keep people out of a poverty trap. So in order for people to enjoy some quality of life from the age of 60, whatever, on, it will be necessary to supplement your income. So yeah, you can have any number of pensions. There are revenue guidelines and revenue limits about maximum limits or maximum benefits that you can draw from it, but they're very, very generous. And most people won't come within. They won't reach those limits. Most people won't. So you can have any number of personal pensions or.
Yeah, I know people have wondered that if they've contributed into a pension and kind of whatever 20 years time, would they be kind of penalised from the state pension if it was kind of means tested in that regard?
No. The means test only applies to the non-contributory old age pension, or if somebody is applying as an adult dependent for somebody who's drawing the state pension. The means test applies to that, and even at that, the means test is actually pretty generous. But for somebody, that is something I've heard down through the years as well. Look, the state look at me, if I take out a pension, I'm going to be hit for tax X, Y, and Z. That's not the case. And what you're going to find is governments are actively encouraging people to take out their own personal arrangements.
Okay.
So you shouldn't have to worry about that.
I have another question for you that's come in now again from a contractor, John, and it's a good question, I think. So this contractor has a pension. Can his wife draw it if he passes away?
That depends. It depends. Now, currently, if I take it this individual is still contributing to the pension and hasn't drawn the pension yet.
Yeah.
If he dies now, the benefit will pass directly onto his wife and it'll be passed into his estate. So there's nothing to worry about there. When it comes to post-retirement, he will have to decide on what type of pension he draws off.
Okay.
The older pension, it was known as an annuity contract, which basically an annuity is a guaranteed income for life. So if, for example, he goes down that route, he will have to decide what type of annuity he wants to buy. Now, you can buy a single life annuity, which means it's paid to you and you only, or you can include a spouse's pension in it. The spouse's pension would normally be 50% of what your own pension is.
Right.
But that would have to be included when the individual comes to retirement and says, yeah, I'm going to draw my pension out. I want to buy an annuity to provide an income for life, but I also want to provide a spouse's pension so that if I die, my partner or my spouse will continue to receive an income.
Yeah.
But that would very much depend. If he goes, there's another route then as well where you can actually put the money into a fund called an approved retirement fund. And if he dies, the entire value of that fund passes tax-free to his wife. So that's possibly a better way to do it.
Okay.
But again, it's horses for courses. It's individual circumstances will dictate that.
Yeah.
But either way, you can set it up that there will be a spouse's pension paid, or that the fund would pass on to your spouse to make sure that she gets the full, or he gets the full benefit of it.
Okay, I think that's definitely one that's worth investigating. Something I suppose we don't want to think about, but yeah, just God forbid if something like that happens, it's just nice to have that comfort of knowing that, you know, your spouse is going to be looked after.
And that was an issue, Cliona, for a long time, because people, and rightly so, that was addressed back in the early 90s, the late 90s, 1999, when the government realised that one of the obstacles to people taking out pensions was that in the older model of pension, there was a danger that it would die with you.
Yeah.
So they introduced a whole raft of legislation over the years to ensure that people had plenty of opportunities to make sure that didn't happen. And, you know, there are plenty of ways to provide that now.
Okay, that's great. John, while I have time, to open a company pension for a limited company, must this be done through a pension company, or is there a facility to open one through an online platform? Again, a question that's coming there through the Q&A.
The online platforms I'm not overly familiar with.
Okay.
Company pensions have to be written in trust. So you would normally you could set up a self-administered pension, small self-administered pension. Now, they were flavour of the month for quite a long time, but there's legislation coming down the tracks from Europe, which will be enacted either at the end of this year or early next year, that it's going to make that option very, very expensive and not as attractive as it used to be. So I'm not, as I say, I'm not terribly familiar with the online thing, but I can't see how it would work, because you would need to set up the policy in trust. If you go to an insurance company, they will they'll take care of the trusteeship. In fact, all the insurance companies nowadays have set up independent trustee companies to act as trustees for the pension fund. So I'm not aware of any online facilities for setting up online trust. And certainly for company pension plan, you're probably better off going down the tried and trusted route of dealing with an insurance company and having it set up in trust with independent trustees.
Absolutely. Jan, thank you so much for your time. I learned an awful lot today, and look, we tried to address, like I said earlier, kind of an audience really of different age groups, different stages in their lives. So maybe, you know, the young person kind of out of college starting off, you know, should they look at pensions? The answer is yes. It sounds very boring, but as you said, you know, you can, you know, invest kind of a minimal amount of money. If, you know, your life, you know, can continue. If you need to go in, you're not working, you're going traveling, you can put it on pause and come back. You know, we looked at the scenario of somebody who worked overseas, had a pension, they come back to Ireland, starting off again, can their pension resume? The answer is yes. And then, of course, you know, we had somebody then in their 40s who was moving from permanent employment into contracting. Can they bring their pension with them? They can, of course. And then that was very interesting as well about people, you know, with you know, who have a spouse, and you know, what happens to your pension there, kind of be transferred. And again, yeah, the answer is yes, and that's really good to know. So, John, we had a lot of people joining us today, and we can't cover every question. But I would just like to say to everybody that if you want to get in touch with John, he's at ffpatlive.ie, and you can go there for a free consultation. Am I right in saying that, John?
Absolutely, yeah. Anybody. Yeah, anybody who needs information, just give me a shout. Yeah. Yeah,
or is there that's the easiest way, is it to go through that, ffpatlive.ie?
Yeah, or go through the website, Forsythe.ie, or give me a phone. Pick up the phone and give me a ring.
Okay, and give you a ring. Yeah.
And anybody who has any particular queries, I do my best to answer.
Yeah, and like, you know, you can talk to people outside of pension queries as well, kind of that general kind of financial advice, I suppose, you know, support for anybody. So, John, I've learned an awful lot today anyway.
I'm glad to hear it.
When you start kind of talking or thinking about pensions, you know that, yeah, it's kind of time to go up and kind of...
I know. It's a fascinating subject, isn't it?
Yeah. Yeah. Absolutely. John, I really appreciate your time. That was great, and I'm sure our contractors, Berkley's contractors, and people outside will have found that very valuable as well. I'm Cliona Quaid, the contractor manager with Berkley, and likewise, if you ever have any queries, you want to email me, cquaid@berkley-group.com. Thanks everybody, and thank you, John.
Okay, Cliona, thanks very much for the nice talk.
Yeah, and we really appreciate it. Thanks ever so much. All the best, John.
Bye now.